Welcome back to the Deep Dive, where we cut through the noise to get you truly well-informed. Today, we're tackling a topic that, well, it touches nearly everyone's financial future. Making money in the stock market. Forget the fleeting trends, the latest rumors. We're diving deep into a system honed over a century of market history, really designed to identify the stock market's biggest winners.
Exactly. Our mission today is to distill the core principles from William J. O'Neill's, his seminal work, How to Make Money in Stocks.
Yeah.
We've meticulously gone through the introduction, chapters 1 through 20, and wow, some incredible real-world success stories. Our goal is basically to extract the actionable framework for identifying these super-performing stocks, understanding market cycles, and managing your investments with clear, proven rules.
So whether you're planning for retirement, maybe saving for a big goal, or just inherently curious about how the market really works beyond the daily headlines, this deep dive is definitely for you. We're going to equip you with insights that, honestly, could dramatically change how you view and participate in the world of investing. We're talking about recognizing powerful patterns, understanding market signals, and learning directly from history's greatest winners. It's kind of a shortcut to smart, disciplined investing with just enough personality to keep you hooked. Okay, let's unpack this. The book opens with a really powerful assertion. You can learn and benefit immensely from America's 100 years of super winners. After market debacles like, 2000, 2008, many investors know they need to learn more, but they often don't know where to turn. So what's the fundamental takeaway from this historical perspective that O'Neill emphasizes so much?
What's truly fascinating here is the unwavering emphasis on patterns repeating. It's almost counterintuitive, isn't it?
Yeah.
Despite these monumental shifts in technology, economic structures, global events over the last century, the underlying human nature and the fundamental laws of supply and demand in the stock market, they remain remarkably constant. This means that if you look at chart patterns from 50 or even 100 years ago, they are almost identical to the strongest patterns we see today. O'Neill makes this point vividly. He contrasts the incredible gains of stocks like the Richmond and Danville Railroad in 1885 or Northern Pacific in 1901, which raised from $115 to $700 in a week, with 21st century powerhouses like Apple and Google. The mechanics of massive price appreciation, they're basically timeless.
It's just astonishing to hear that these patterns are so consistent across a whole century. Why do you think, though, despite all this historical evidence, so many investors still overlook or, outright dismiss the power of charts and past data?
That's a really crucial question. I believe many investors are sort of wired to chase the new thing, or they get swayed by the daily media narratives instead of doing the meticulous work of studying history. They want to predict the unpredictable, right? Rather than recognizing recurring behaviors and acting accordingly. The market, at its core, it's a reflection of human nature and crowd psychology, playing out daily through supply and demand. Those who refuse to learn from this past are truly missing out on an inspiring and, frankly, proven advantage. It's about developing a systematic approach, not just relying on gut feelings or, what some pundit says.
Okay, so with that crucial foundation of charts and historical patterns, how do we actually put this into practice? This is where O'Neill hands us the CANSLIM system, a really powerful framework distilled from decades of market winners. What's the big idea behind it, and can you briefly introduce what each letter stands for?
Yeah, the big idea, laid out in Chapter 1, is that the greatest winning stocks, these super performers, they share 7 common characteristics right at their early stages. CANSLIM is just an acronym for these characteristics, giving you a simple, easy-to-remember formula. It's a method to identify companies with robust fundamentals and strong technical price action before they make their massive moves. If we connect this to the bigger picture, it's a brilliant synthesis of fundamental and technical analysis. Both are crucial for a thorough understanding. And the book immediately brings this to life. It showcases 100 annotated color charts spanning from 1880 all the way to 2008. We see examples like Dome Petroleum's the 1,000% advance, Limited Stores with a, 3,500% surge, Cisco Systems going from split-adjusted 10 cents to $82, Home Depot and Microsoft both multiplying their value over 20 times. These aren't just isolated incidents. They're powerful demonstrations that these principles apply to extraordinary gains across vastly different eras and industries.
Right. But many amateur investors, and I've been there myself sometimes, dismiss charts as complicated or maybe irrelevant. But Chapter 2 makes it crystal clear most professionals wouldn't dream of investing without them. Why are charts so invaluable, and what are we actually looking for when we read them?
Well, charts are invaluable because they provide raw, factual price performance. That's the key. They record the daily dance between supply and demand. They reveal what's actually happening in the market, not what someone thinks should happen. Learning to decode these movements gives you an enormous advantage over those who are, frankly, either too lazy, uninformed, or just refuse to learn. It's not about trying to predict the future with a crystal ball or anything. It's about interpreting the present by recognizing strong, reproducible price patterns. Often failures can be traced back to faulty or maybe just too obvious bases that attract, let's say, less discriminating traders. And when charts are combined with volume data, they become even more powerful. They reveal institutional buying, what we call accumulation or selling distribution. These are vital insights that no personal opinion or news headline can possibly provide.
Okay, so to make this more concrete for everyone listening, what are some of the most important high-probability chart patterns that historically signal a major advance is coming?
Absolutely. Let's get into some specifics. One of the most frequently observed and powerful patterns, it appeared, in over 100 of O'Neill's superperformers, is the cup with handle. Imagine quite literally a coffee cup with a handle on the right side. The cup forms a rounded bottom, then the handle forms as a smaller, typically tighter consolidation on the right side. Usually it's in the upper half of the base, ideally above the 10-week moving average. The price drop within that handle is usually contained within, say, 8 to 12%. Though in bear market shakeouts, it can definitely be deeper, maybe 20 to 30%. This pattern has been a remarkably consistent signal across history. You see it from SS Krej way back when to Xerox in more modern times. The key is recognizing this shape as a sign of price consolidation before a potential breakout.
A coffee cup. Okay, I can picture that. What else should we be looking for?
Right. Another common pattern, though maybe a bit less frequent, is the double bottom. It looks like the letter W. Now here, you want to see the second bottom of the W match, or critically slightly undercut the first bottom. That undercut is what we call a shakeout. It basically flushes out weaker investors before the stock makes its real move up. Smart money shaking out the nervous holders. The pivot buy point, where you'd ideally enter the trade, is on the top right side of that W bag, as the stock starts moving up strongly from its second low. Companies like Cisco Systems and eBay, they've exhibited this pattern before some really big runs.
Okay, cup with handle, double bottom. Any others that are particularly potent?
Yes, there's the high tight flag. Now this one is quite rare, but incredibly powerful when you find it. This one starts with an explosion. The stock just shoots up 120% in just 4 to 8 weeks. Really rapid. Then instead of collapsing, it corrects sideways, very gently, by only maybe 10-25% over 3 to 5 weeks. It's considered one of the strongest patterns because that tight sideways action after such a huge initial run shows immense underlying strength and institutional support. They're absorbing any selling. It's definitely risky due to its volatility, but it can lead to massive 200% plus skyrockets, as seen with a stock like Kustaf back in the day.
Wow, that sounds intense. 100% in a few weeks, then just sideways.
Exactly. And finally, we have the base on base, or ascending base. Imagine a stock makes a big move, then consolidates in a base pattern, like a cup with handle or maybe a flat base. If the general market pulls back, but our strong stock holds its ground and builds a second consolidation area directly on top of or maybe slightly above its previous base, that's incredibly bullish. It's showing what we call relative strength. Ascending bases specifically involve higher lows and successive pullbacks within the base, indicating strong and growing demand. Companies like National Airlines and Oracle have shown these patterns, and they often surge when the broader market turns positive again.
You know, that's a lot of incredible historical context there, especially drilling down into those chart patterns. I'm picturing myself trying to spot a cup with handle for the first time. Probably feels like trying to find a specific cloud shape in a rapidly moving sky. Is there a particular aha moment that usually clicks for new investors when they start getting charts?
That's a great way to put it. And yes, the aha moment often comes when you stop trying to predict and start trying to interpret. It's like learning a new language, right? At first, it's just lines and squiggles, maybe seems like gibberish. But then you start to see the recurring words and phrases, the patterns. For charts, that moment usually happens when you realize the patterns aren't random. They're actually a visual representation of institutional buying and selling, big money-moving things. When you see a stock breaking out of a well-formed base on heavy volume, it's like the market is practically shouting at you, hey, here's where the big money is moving. That's the real power, that insight.
You mentioned volume again, which the book really stresses as the best measure of supply and demand. What specifically should we look for regarding volume? How does it confirm these patterns?
Big volume at key points is truly indispensable. Think of volume as the fuel for the price move. A constructive sign, while a stock is still forming its chart base, is when the number of up weeks on clearly above average volume outnumbers the down weeks on above average volume. This difference indicates accumulation that institutions are actively buying, soaking up shares quietly. Conversely, you should be wary of wide and loose price structures or bases with really wide price swings every week. These tend to be failure-prone. Why? Because they're constantly in the market's eye, attracting less discriminating traders, maybe getting hyped up before they often fail. Solid bases usually show tight price action and relatively quiet volume until the breakout happens on heavy volume.
Okay, so if we spot one of these promising patterns and the volume looks right, confirming accumulation, how do we know when to buy? It sounds like timing is absolutely critical to avoid getting caught in a false move or shakeout.
Timing is everything. Seriously. The winning investor waits patiently for precise pivot points. This is the spot where the real move generally starts and all the exciting action begins. If you try to buy before this point, you're being premature. Stock might just stall or even drift lower, shaking you out before the real move. You have to let the stock prove its strength first. And crucially, O'Neill hammers this home. Never buy more than 5% to 10% past the precise pivot buy point. Going beyond that dramatically increases your risk of getting caught in normal, healthy corrections that would then trigger your automatic loss-cutting rule. You buy too high, you get stopped out on a normal pullback. A common mistake is waiting for a stock to make a new all-time high. Many pivot points occur at the peak price in the handle area of a cuff with handle, for example, which is often somewhat below the base's absolute highest price point. Waiting for the absolute high can mean you're already buying too late and chasing.
Okay, that 5-10% rule past the pivot is super important. Now, with that crucial foundation of charts and timing established, let's break down the core characteristics of these super performing stocks. We're diving into the CANSLIM framework, starting with C for current big or accelerating quarterly earnings and sales, as discussed in Chapter 3. The book really emphasizes this. What's the minimum expectation here, and why is it so critical?
Yeah, the core insight here for C in CANSLIM is that mediocre earnings growth is, well, it's a red flag, not a green one. You shouldn't settle. We're hunting for a fundamental surge thing, 25 to 50% year-over-year growth in quarterly earnings per share, or EPS, at a bare minimum. Often it's much higher. The really great companies show gains of 100% to 500% or even more in their breakout quarter. Why? Because anything less, that sort of 5-10% good enough growth, it just doesn't have the rocket fuel needed to launch a super performing stock into orbit. And this isn't just about, say, aggressive cost cutting either. The earnings growth must be supported by higher sales to be truly sustainable and indicate real business momentum. If earnings are up sharply but sales are flat or weak, it's a warning sign. The book uses Waste Management in 1998 as an example. Huge EPS gains without sales growth preceded a collapse. We're looking for genuine business expansion, just like Dell, Cisco, Google, and Apple all showed with massive EPS gains right before their explosive runs.
Got it. So current quarterly earnings are clearly the spark. But as we know, one good quarter doesn't necessarily make a trend. That's where A for annual earnings comes in, right? Covered in Chapter 4. How did these longer-term figures provide that crucial validation?
Exactly. While a powerful current quarter is vital, the annual earnings provide the proof that the latest results aren't just a flash in the pan. It shows consistency. You must insist on annual EPS increasing in each of the last 3 years. This shows a track record. The combination of strong quarterly and strong annual growth makes for a superb stock candidate. It helps ensure stability and consistency. The book also suggests looking for stability ratings below 2025. Think of this as a measure of how erratic a stock's past price movements have been. Less erratic is generally better. A lower number generally means a more predictable, less volatile stock, exactly what you want when you're building a strong position. And importantly, O'Neill argues against investing in older, larger organizations with slower, say 10-15% annual growth. He believes America's real growth is driven by new, innovative entrepreneurial companies, not necessarily the established giants that are often too large to continually innovate at a rapid pace.
Okay, that makes sense. Focus on the innovators. Now, N for new, in Chapter 5, seems to really encapsulate that spirit of innovation and fresh opportunity. Why is new so important for these dramatic stock price advances?
Well, it's because it usually takes something new, a groundbreaking new product, a revolutionary service, maybe even new management shaking things up, or significant changes in industry conditions, to produce a truly startling advance in a stock's price. These new elements are the catalysts. They accelerate earnings faster and create real excitement and buzz around the company. But again, it's not just any new. These stocks should be bought at new price highs after emerging from sound price consolidation patterns, not just any random new high they happen to hit. We've seen this time and again throughout history. Northern Pacific is the first transcontinental railroad, General Motors evolving from Buick, Syntex pioneering the oral contraceptive pill, McDonald's revolutionizing fast food franchising. More recently, America Online broke out with multiple new characteristics. The ideal time to buy is during a healthy bull market,
precisely as a stock breaks out of its price base. But I'll say it again because it's critical. Buying more than 5% to 10% above that exact pivot buy point is risky. It just makes you much more vulnerable to being shaken out in a normal correction.
Right, sticking to that buy zone is key. Chapter 6 addresses S for supply and demand. This sounds like Fundamental Economics 101 applied directly to stock picking. How does supply and demand manifest in stock prices, and what are the practical lessons investors should take away?
It's more critical than almost any analyst's opinion, frankly. Think of it simply. A stock with, say, 5 billion shares outstanding is incredibly hard to move significantly. It takes huge buying pressure. But a stock with just 50 million shares, it requires far less buying volume to significantly move its price upward. Basic physics, almost. This principle is why you often see such explosive moves in smaller, more agile companies. There's just less stock available. This also extends to companies actively buying back their own stock. When a company does this, it reduces the supply of shares available to the public and can boost earnings per share. This is generally a very positive sign, especially for small to medium growth companies. A 10% buyback, for instance, is a strong signal of management confidence. On the flip side, investors should be wary of what O'Neill calls caretaker managements in large companies, executives who often own little stock themselves and seem to lack the drive for innovation. Also, be cautious about excessive stock splits, think 3-for-1 or 5-for-1, versus the more typical 2-for-1 or 3-for-2. Too many splits can flood the market with supply, potentially pushing a company prematurely into a lethargic big cap status and limiting its future high growth potential.
Okay, fewer shares, more potential bang for the buck, essentially. Now, we're always told to back winners. Chapter 7, L for leader or laggard, explains how we identify a true leader in the stock market sense. Why is it so vital to avoid the laggards, even if they seem tempting because they look cheap?
You absolutely must buy companies that lead their industries. And we're talking about the number one in their field. Now, that doesn't necessarily mean the biggest by size or the most famous brand. It means number one by superior quarterly and annual earnings growth, high return on equity, the widest profit margins, the strongest sales growth, and dynamic stock price action. They often have a unique product or service and are clearly gaining market share from competitors. This raises an important question O'Neill poses. Why do so many investors gravitate towards sympathy plays, buying weaker competitors in a strong group or laggards that look cheap on the surface? It's often because they're hoping for a turnaround, which frankly rarely happens with the kind of explosive returns we're looking for, or they think cheap is good. O'Neill's study showed that the average relative price strength, or RS, rating for the best performing stocks before their major run-ups, was an impressive 87. What does that mean? It means they had already outperformed 87% of all other stocks in the database over the last year before they made their biggest move. So the rule's pretty strict.
Restrict your purchases to companies with RS ratings of 80 or higher. Don't buy weak stocks. Look at Home Depot back in the day, which dramatically outperformed its struggling competitors like Hetchinger. Many of the greatest winners, from Syntex and Pickens, Save to America Online, Google, and Apple, were all undisputed leaders in their space when they began their major runs. As Andrew Carnegie famously said, the first man gets the oyster, the second the shell. This really holds true in the market. Go for the oyster.
Go for the oyster. I like that. Okay, so we've identified the characteristics of the company itself, but who are these big buyers that actually fuel the demand for these leading stocks and drive those prices up? Chapter 8, Aisle for Institutional Sponsorship, delves into this.
Right, these are the heavy hitters. Institutional investors, we're talking about mutual funds, pension funds, hedge funds, sovereign wealth funds, banks, insurance companies. These are the giants that account for the vast majority, maybe 70, 80% of all market activity. You want to see stocks with increasing sponsorship from these big players. Ideally, you'd like to see at least one or two top-notch mutual funds with strong recent performance records buying the stock. And crucially, look for significant ownership by the company's own management. This indicates a strong belief in the company's future from those who know it best. Skin of the game. Top-performing funds like Fidelity's Contra Fund, managed by Will Danoff, or American Century Heritage under Jim Stowers, are often among the first to spot these winners. Their buying is a good sign. However, it's equally important to avoid the favorite 50 or stocks that are already heavily overowned by institutions, as they are often late in their price cycle and vulnerable. Consider the devastating collapses of Citigroup and AIG in 2008, despite being massively institutionally owned. Too much ownership can be a curse. Cisco and America Online were also heavily overowned before their respective market tops. So institutional sponsorship provides crucial liquidity when you eventually need to sell, but overownership can lead to heavy supply during bear markets, intensifying declines because everyone's trying to get out the same narrow door at once.
Finding that sweet spot of increasing but not excessive institutional interest. Okay, this next one feels huge. M for market direction in chapter 2. This is where it gets really interesting. Maybe even a little scary. You can pick all the right stocks, follow every single CANSLIM rule perfectly, but if the overall market goes south, you're likely in deep trouble regardless. How do we determine the market's overall direction? This seems absolutely paramount.
It is paramount. You nailed it. This is arguably the single most crucial chapter in the entire book. Why? Because your portfolio will likely plummet if you're fighting a bear market, no matter how good your individual stocks seem. As O'Neill says, maybe 3 out of 4 stocks just follow the general market trend. Many people learned this the hard way in 2000, again in 2008. The best way to navigate this isn't through listening to forecasts or economists' opinions, but by carefully following the daily price and volume charts of the major general market averages. The S&P 500, the NASDAQ Composite, the Dow Jones Industrial Average, and the NYSE Composite. This allows you to objectively identify if we're in a bull market, uptrending, or a bear market, downtrending, based on factual price and volume action. Why do so few investors, even many professionals, have a reliable method for this? It really boils down to discipline and a willingness to interpret the data, not just react emotionally to headlines or wishful thinking.
Okay, so we need to watch the indexes daily. What are the specific signals we're looking for on those charts to know if the market is topping out, potentially heading into a downturn, or maybe bottoming and starting a new rally? Let's simplify this for our listeners.
Okay, let's break it down. To identify potential market tops, you need to watch for something called distribution days. Think of these as subtle, early warning lights flashing on the dashboard. A distribution day occurs when a major index, let's say the NASDAQ or the S&P 500, closes down for the day on higher volume than the previous day. The decline needs to be more than just marginal, say more than 0.2%. What does this signify? It suggests a significant number of institutions might be quietly selling off shares, distributing stock to the public near a peak. When you see 4 or 5 of these distribution days clustered together over a relatively short period, maybe a 4 to 5 week span, that's a strong historical signal that the market is likely topping out or under pressure. The NASDAQ in early 2000, for instance, gave its first clear distribution warning on March 10th, then closed down 4% on very heavy volume on March 14th, marking a third warning that definitively signaled a major market top was in place.
4 or 5 days of index drops on higher volume in a month or so. Got it. What about the flip side? How do we spot a potential market bottom and the start of a new bull run?
Right. Identifying market bottoms and the start of a new sustainable rally involves looking for a specific signal called a follow-through day. Here's how it works. After a significant market decline, the market will eventually attempt a rally. It might bounce for a day or two. You watch this attempted rally. Then, on the 4th day or later of this attempted rally, the most powerful follow-throughs usually occur between the 4th and 7th days, historically. You look for one of the major averages to follow through. This means the index needs to have a booming gain for the day, maybe 1.5% or 2% or more, on significantly heavier volume than the day before. This isn't just a dead cat bounce. It's the institutional money confirming, with conviction, that a real rally attempt is underway. It's the market telling you, through its actions, that a new uptrend might be forming. For example, O'Neill notes the 1998 market bottom saw a powerful follow-through on the 5th day of its rally attempt, with a solid 2.1% market gain on increased volume. That was the signal to start carefully buying leading stocks again.
That's incredibly practical. Follow-through days. Okay. Beyond these specific chart signals for the indexes, the book also touches on how even government policies can influence these market cycles. Can you elaborate on that connection a bit and maybe link it to how external factors can subtly shape the investment landscape we operate in?
Absolutely. While the market itself, its price and volume action, is always your best and most immediate barometer, government actions can have a profound and sometimes quite unintended impact on the economy and the market. The book highlights, for example, how the significant beefing up of the Community Reinvestment Act, CRA, back in 1995, which the source describes as a well-intentioned big government program designed to encourage banks to make more higher-risk loans in traditionally underserved areas, arguably contributed significantly to the subprime mortgage meltdown and the subsequent 2008 financial crisis. The source suggests that despite its worthy social intentions, the policy unfortunately led to severe unintended consequences by lowering lending standards across the board, putting the whole financial system in jeopardy years later. It really connects to the broader theme that external factors, often policies enacted with good intentions but perhaps lacking foresight into potential systemic risks, can profoundly influence market behavior and economic outcomes. This creates cycles and risks that investors need to be aware of, even if they can't directly control those policies. It's part of the landscape.
Okay, shifting gears a bit into managing our money once we start investing. Chapter 12, Money Management, covers a lot beyond just stock picking. What are the key takeaways regarding diversification and maybe other investment vehicles like margin or options? Because, diversify, diversify, diversify is almost gospel for many investors.
That's a great point to challenge, and O'Neill definitely does. He has a pretty strong, maybe even contrarian stance against broad diversification. He aptly calls it a hedge for ignorance in the book. His argument is that the best results, the truly life-changing returns, are usually achieved through concentration, essentially putting your eggs in a few baskets that you know well and washing them very carefully. He points out quite starkly that broad diversification didn't really protect many portfolios from severe losses during the major market breaks of 2000 or 2008. Owning a little bit of everything just meant you lost money everywhere.
Wow, a hedge for ignorance. That's a pretty strong stance against something seen as fundamental risk management. What's O'Neill's counterargument to the idea that having diverse assets offers crucial protection against, say, one company failing or a whole sector downturn? Are there specific scenarios where even he might recommend a bit more spread?
Yeah, it's definitely provocative. His counterargument is essentially that most people who own, say, 20 or 30 stocks don't actually know enough about any of them to truly manage that diversification effectively. They're just spread thin. If you're going to own just a few stocks, maybe 4 or 5 for an average portfolio size, 20K, 200K is the range mentioned, you must know them intimately. You need to monitor them rigorously, almost daily. The goal isn't just protection through dilution. It's achieving superior performance through concentrated bets on the very best companies. As for scenarios recommending more spread, O'Neill would likely argue that if you're truly doing your homework and following the CANSLIM rules correctly, you will naturally end up diversified across different leading industry groups because leadership rotates. And crucially, your strict 7-8% loss-cutting rule provides the ultimate risk protection, not just owning a little bit of everything and hoping for the best. It's active risk management versus passive diversification.
Okay, so concentration with strict loss rules is the core idea. What about things like holding periods, margin, or short selling?
Right. Regarding long-haul investing, the holding period itself isn't the main issue. It's buying the right stock at the right time. And, just as importantly, selling when the rules dictate either taking a profit or cutting a loss. Interestingly, studies show most losers are actually held for shorter periods, typically weeks to maybe 3 months, before being gumped. Winners, the big ones, can be held much longer, sometimes years, as long as they continue to act well and meet the criteria. Margin can offer an advantage, leverage, but only for experienced investors who are absolutely disciplined about cutting losses strictly. It's not for constant full use, as it magnifies losses just as much as gains. Short-selling betting on a stock going down is described as very difficult, highly specialized, and really should only be attempted during confirmed bear markets. And even then, you need to cut losses quickly, maybe at 8%. Definitely don't short strong, advancing stocks just because they seem too high. That's a recipe for disaster. Options are generally considered too speculative and complex for most individual investors. If used at all, longer time periods, like 6 months or more, are generally better than short-term gambles. And definitely don't write naked selling calls without owning the underlying stock, which carries unlimited risk.
What about IPOs? They get a lot of hype.
Yeah, IPOs, initial public offerings. O'Neill suggests it's safest to buy them after they've been trading for maybe 1 to 3 months and then break out from their first proper consolidation pattern or base. A good example cited is Google in September 2004. Don't chase them on day one. Interestingly, the research shows most big winning stocks had their IPO within the prior 1 to 10 years. So looking at relatively recent IPOs that are setting up correctly is a key strategy. As for other assets, bonds, futures, gold, real estate, mergers, foreign stocks, the book generally advises most individual investors focusing on growth stocks to avoid them. They often involve too much complexity, lack liquidity, might be poor inflation hedges, or carry specific risks that the average person can't navigate easily or effectively compared to focusing on leading U.S. growth stocks. The book drives this point home with examples of failed corporate diversification, like Mobil buying Montgomery Ward or Sears buying Dean Witter. And it shows charts of the dramatic losses in seemingly safe diversified giants like Citigroup and AIG in 2008, illustrating that size and diversification don't always equal safety.
That's a really important point about focusing. Now, beyond individual stocks, Chapter 15 really emphasizes that the industry group and the broader sector matter significantly. How much does this really influence a stock's movement, and how should we factor it in?
It's huge. A stock's price movement is heavily tied to its industry group. O'Neill's research suggests the industry group accounts for about 37% of its move, and the overall sector contributes maybe another 12%. So you're looking at roughly half of a stock's potential move being driven simply by the strength of its respective group. That's massive.
Therefore, you absolutely must consider the industry before purchasing a stock. Is the group strong and showing leadership? The key insight here is that specific industry groups tend to lead each new market cycle. But, and this is important, the leaders from the last bull market often don't repeat in the next one. You need to find the new leaders. The data indicates that 60% or more of the biggest winning stocks are part of strong group moves. It's much easier to succeed when you have the wind of a strong group at your back. For example, the book mentions mobile home stocks like Redmond Industries absolutely zoomed in the early 1970s. Then computer industry leadership shifted dramatically over time, from the old IBM-type companies to Siebel, Oracle, and Emulex in the late 90s, and then later to names like Google and Priceline.com in the 2003-2007 cycle. New leadership emerges with each cycle, and your job is to identify and be in those fresh leading groups.
That's a really sharp insight, thinking about that ripple effect from a booming industry finding the new leaders. And then the book throws in this concept of a cousin stock. I'd never heard that term before. What exactly is a cousin stock, or how does it play into this group dynamic? Are these cousin stocks typically less obvious picks, maybe? And does that make them potentially more lucrative if you spot them early?
It's a fantastic observation. And yes, they can definitely be less obvious and potentially very lucrative. A cousin stock is essentially a supplier company or a related company that benefits indirectly but powerfully from a boom and a primary industry group. They're related, like cousins. A classic example O'Neill uses is Monogram Industries. During the big airline manufacturing boom of the mid-1960s, Boeing was selling jets like crazy. Monogram Industries supplied the chemical toilets for those Boeing jets. Not glamorous, right? But with Boeing booming, Monogram's earnings grew 200% and its stock saw a phenomenal 1,000% advance. Similarly, another company called Techstone benefited hugely by supplying paneling to the booming recreational vehicle RV manufacturers back then. These are companies that aren't the direct stars of the hot industry, but they are critical components or suppliers, essentially riding the coattails of that industry's success. They often fly under the radar a bit longer than the main players, which can make them potentially more explosive if you spot the underlying industry trend early and connect the dots to the key suppliers. It's about seeing the whole ecosystem, not just the lead actors.
Finding the chemical toilet supplier to the jet boom. Love it. Okay, let's talk news. News is everywhere. 24/7, we're constantly bombarded. But Chapter 17, Watching the Market and Reacting to News, tells us how to interpret it correctly, especially when the market often does the complete opposite of what seems intuitive based on the headline. It sounds like a real minefield for the unprepared investor.
It absolutely can be paradoxical and very confusing, especially for market neophytes. It's a minefield, as you say, because often the market has already discounted or priced in the news well before it actually breaks publicly. The smart money already knew. So, for example, a seemingly bad earnings report can sometimes cause a stock to actually go up. Why? Because if the bad news was already widely anticipated or feared, the actual announcement removes the uncertainty. Professionals who are short might cover their positions, or buyers might step in thinking the worst is now officially over. The book also emphasizes quite strongly that the national news media, however, can often be heavily biased and agenda-driven, making it incredibly difficult for an individual to separate objective facts from opinions or narratives. It cites examples of what it views as one-sided reporting in areas like politics and economics. The most questionable practice highlighted is how media outlets select which stories to cover and promote heavily, and perhaps even more importantly, which critically relevant stories or inconvenient facts they choose not to cover, maybe because they don't support a particular editorial stance or agenda. It urges readers to be critical consumers of news.
That's definitely a significant challenge for investors just trying to stay informed and make rational decisions. And the book draws this fascinating, almost chilling parallel between the market action around the 2008 crisis and historical periods, specifically saying it's not like 1929, it's 1938. Can you explain that analogy and what lessons we should take from history's echoes?
Yeah, it's a really powerful and somewhat sobering historical comparison O'Neill makes. He presents an overlay chart placing the NASDAQ Composite Index from the 1990s tech bubble through March 2009 directly over the chart of the Dow Jones Industrials from the Roaring '20s boom through the Great Depression lows and subsequent recovery into the late 1930s. And the similarities in the patterns of the boom, bust, and initial recovery phases are striking, almost uncanny. For instance, the NASDAQ's dot-com bubble soared about 2.5 times higher than the Dow's 1928-29 climax run-up, showing even greater speculative excess. Then the NASDAQ subsequently declined a brutal 78%, which closely mirrored the Dow's devastating 89% crash in 1929-32.
Even the recovery rally showed parallels. The rally from the 1932 low to the 1936-37 peak lasted roughly the same amount of time as the Nasdaq's rally from its 2002 low to its 2007 peak, and both were followed by significant secondary declines of around 50%. Now, the point isn't that history repeats exactly tick for tick, but it strongly suggests that understanding historical market behavior, the patterns of speculation, collapse, and recovery, rather than solely relying on current media narratives or assurances that this time is different, is absolutely vital for maintaining perspective and managing risk. History provides a crucial map.
And this section also connects back to government policy, doesn't it? With critiques of how certain policies might have contributed to these cycles.
Yes, it does. Following the historical parallel, the chapter includes some sharp critiques, particularly from economist Thomas Sowell via reprinted editorials. These critiques highlight how government intervention, even when launched with genuinely good intentions, can sometimes have severe unintended consequences down the road. Specifically, Sowell points to what he calls the political crusade for affordable housing that gained steam in the 1990s. The argument presented is that this push, despite its noble goal, ultimately led to a significant lowering of lending standards across the financial system, which in turn fueled the unsustainable housing boom and the subsequent bust that precipitated the 2008 global financial crisis. This powerfully connects back to the idea that market actions and economic stability are often profoundly influenced by broader, sometimes flawed or short-sighted government policies. These policies can create patterns of boom and bust that resonate through history, reinforcing the need for investors to understand these larger forces.
Okay, let's shift to solutions for people who might find individual stock picking too daunting or time-consuming. For those folks, Chapter 18, How You Could Make Your Million Earning Mutual Funds, suggests funds are often touted as a simpler alternative. How should we approach mutual funds to truly make them work for us over the long term?
Right. Mutual funds can be outstanding investment vehicles, absolutely. If, and it's a big if, they are managed correctly by the investor and approached with a truly long-term mindset. The big money in funds, O'Neill argues very convincingly, is made by owning them consistently through several full business cycles, think 10, 15, 20, or even 25 years or longer. Patience is key. A well-selected, diversified domestic growth stock fund, ideally one run by an established management organization with a good long-term track record, will almost always recover from the steep corrections and bear markets that naturally occur along the way. The absolute key is to stay committed for the long haul and strongly resist the urge to try and aggressively time the market by jumping in and out of no-load growth funds based on fear or greed. That's usually a losing game for individuals.
That makes sense for long-term commitment, buy and hold through the cycles. But what about the practicalities? Should we chase those high-income funds if we need income? And what about those huge, really popular funds that everyone seems to be in? Are they always the best choice?
Good questions. If you need income, the advice in the book is actually quite counterintuitive. It suggests picking the best overall growth fund you can find, one with a strong long-term record, and then setting up a systematic 6% annual withdrawal plan yourself. This is generally preferred over buying dedicated income funds or balanced funds, which often tend to underperform growth funds significantly over the long run due to their typically more conservative holdings. Now, regarding fund size, this is critical. O'Neill strongly advises avoiding most of the very largest mutual funds, those with tens or hundreds of billions in assets. Why? Because they often suffer from a size problem. They lack the flexibility and nimbleness to move meaningfully in and out of the smaller, faster-growing companies that often generate the biggest returns. They're forced to buy large-cap stocks, which may have slower growth. Fidelity's Contra Fund, managed by Will Danoff, is cited as a rare exception, a large fund that has historically managed to maintain strong performance, but it's noted as unusual.
What about ETFs? Exchange-traded funds are hugely popular now. How do they fit in?
ETFs get a mention too. While they are acknowledged as very popular and offer benefits like transparency, generally lower expenses, tax efficiency, and the ability to trade them like stocks throughout the day, they still require you, the investor, to make all the buy and sell decisions and time the market correctly. They also carry significant market risk, just like individual stocks or traditional mutual funds. For instance, the book points out that the SPDR Financial Sector ETF, XLF, plunged a massive 57% during the 2008 crisis. Owning an ETF didn't save you there. So the general suggestion in the book is that while ETFs can be useful tools, serious individual investors can potentially make significantly more money over time by focusing on identifying and owning the individual market-leading stocks directly, using the CANSLIM criteria, rather than relying solely on ETFs, which offer broad market exposure but inherently dilute the concentrated gains you get from owning true superperformers.
Makes sense. The potential for higher returns comes with picking the individual winners. Now, Chapter 19 delves into how professional money managers operate, the institutions. This gives us some insight into the smart money perspective, or maybe exposes some flaws. So, what's wrong with traditional institutional approaches, given all their resources? Why do they often seem to underperform simpler strategies?
Yeah, it's a fascinating look behind the curtain, and it's not always flattering for the institutions. The book argues that many institutions make several fundamental mistakes that hinder their performance. First, they often restrict their investments primarily to large-cap companies, mistakenly thinking they're inherently safer or the only place to put large sums of money. This causes them to miss out on the explosive growth of smaller, emerging leaders. Second, they frequently rely on investment committees to make buy and sell decisions. O'Neill contends that committees are typically poor decision-makers in fast-moving markets because they tend to move slowly, seek consensus, avoid bold moves, and are often driven by CYA thinking rather than conviction. Third, many cling to outdated processes that focus more on bureaucratic due diligence, ticking boxes, rather than focusing purely on achieving superior investment performance. And fourth, a big one, is their reliance on traditional valuation models, particularly low PE ratios. As we discussed, a PE ratio compares a company's share price to its earnings per share. Relying heavily on buying undervalued stocks based on low PE ratios frequently causes institutions to completely miss the major winners, because the best growth stocks often command high PE ratios, precisely because of their rapid growth and future potential. Growth stock investing, the book argues, generally outperforms value investing over most long periods.
That's a pretty damning critique, committees, focusing on large caps' flawed valuation methods. What about the Wall Street analysts themselves, the people providing the research these institutions often use? Are they part of the problem too?
Unfortunately, yes, according to the book. Wall Street analysts often face inherent conflicts of interest, particularly potential biases stemming from their firm's investment banking relationships with the companies they cover. Got to keep the banking clients happy. This leads to a well-documented reluctance to issue sell recommendations, even when warranted. Sell ratings are incredibly rare. Furthermore, their research is frequently focused on the wrong companies, often the big, well-known ones, at the wrong time, and many analysts simply lack a deep understanding of market dynamics, chart patterns, and timing. They might be good accountants, but not necessarily good market timers. This disconnect was painfully evident in 2000, when analysts kept recommending tech stocks all the way down, and again in 2008, when they were bullish on oils and banks right before they collapsed. To counter this, William O'Neill Plus Company developed its own extensive database and tools, like the Datagraph books, which evolved into the digital Wanda platform. These tools provide vast amounts of objective, factual data. The book mentions 96 fundamental and 26 technical data points for over 8,000 stocks directly to institutional clients, bypassing the potentially biased analysts' opinions. They aim to provide the raw data for institutions to make unbiased, fact-based decisions. O'Neill's firm itself even made bold, contrarian public calls, placing full-page bullish ads in the Wall Street Journal in 1978 and 1982, correctly calling major market bottoms when sentiment was overwhelmingly negative. This apparently frightened large investors at the time, highlighting the book's recurring theme that majority opinions seldom work in the market. You have to think independently.
Thinking independently based on data. Okay, this brings us nicely to part 4 in chapter 20. Important rules to never forget. This is where the rubber really meets the road. This chapter consolidates years of experience into a concise list of rules, the absolute non-negotiables for investors looking to succeed. What's the single greatest mistake people make, according to O'Neill, and what are the most critical rules we absolutely must adopt?
This really is the culmination, the distillation of everything we've discussed. And O'Neill is blunt. By far, the single greatest mistake that maybe 98% of investors make is not learning from their previous mistakes. They keep repeating them. Success isn't just about acquiring knowledge. It requires consciously unlearning old, ingrained assumptions, bad habits, and emotional reactions, and replacing them with disciplined, historically proven rules. It's so easy to say, oh yeah, cut losses at 7 or 8%, right? But in the heat of the moment, when your stock is down 6%, maybe 7%, and your ego is screaming, don't sell, it'll come back, don't take the loss, that's when the real discipline is tested. And O'Neill's work consistently shows that's precisely where most investors trip up, time and time again. Holding losers is the cardinal sin.
That emotional battle is so real. So let's list some of those absolute non-negotiables, the key mistakes to avoid.
Okay, the crucial ones to burn into your brain. Number 1, absolutely foundational, stubbornly holding on to losses. You must cut every loss short, automatically, maybe using a stop-loss order when a stock falls 7% or 8% below your purchase price. No exceptions, no hoping, no waiting. This is the most serious mistake almost all investors make, and it's devastating. Number 2, Averaging down in price. Never, ever throw good money after bad by buying more shares of a stock as it declines. That just digs a deeper hole. Instead, the rule is average up into your winners. Buy more of what's working, not what's failing. Number 3, not using charts or misinterpreting them. Charts are essential tools for understanding price patterns, volume, and timing your entries and exits. And don't be afraid to buy stocks making new highs if they're emerging from sound bases, those 7-8 weeks or longer consolidation patterns we talked about. New highs off proper bases are bullish, not bearish. Number 4, not having a sell plan. Most investors focus 90% of their effort on buying. But having a clear plan for when to sell, both to take profits and, more importantly, to cut losses, is easily half the homework needed for success.
And number 5, buying low-price stocks, often those under $10 or $15. They might seem cheap, but they're usually cheap for a very good reason. They typically have higher risk, poor fundamentals, and lack the institutional sponsorship needed to fuel a big move. Big winners rarely start out as penny stocks.
Those 5 are huge. Any other key rules?
Yes, the chapter emphasizes focusing on newer entrepreneurial companies, often those that had their IPO within the last 8 to 10 years, as they tend to have the most dynamic growth, and maybe the most important mindset rule. Forget your pride and ego. The market is always smarter than you are. Don't argue with the market's verdict. Don't try to prove you're right and the market is wrong. That's the fastest way to lose serious money. Accept the market's message and act accordingly based on your rules.
Humility before the market. Got it. Now, theory and rules are one thing, but seeing it work in the real world is another. The book provides some really inspiring testimonials and case studies of people who use these CANSLIM principles to achieve significant success. Can you share a few of those stories that really bring these ideas to life?
Absolutely. These stories are powerful because they demonstrate that the CANSLIM principles are not just theoretical concepts in a book, but a practical, actionable system that everyday investors can use to achieve extraordinary results, if they're willing to put in the work and maintain the discipline. One classic detailed example is the PMD Fund Transactions Chronicle from 1961 to 1986. This was a small investment club O'Neill was involved with early on. It started with just $850, literally $10 contributed from each of his Harvard Business School section mates. Over 25 years, that tiny initial investment grew to over $51,653, even after accounting for taxes and distributions. That's nearly a 50-fold after-tax gain. The fund's progress was documented, including an impressive 474% gain on the original investment by just the end of 1963. It also provides valuable specific trading lessons. For example, buying Dome Petroleum at $77 and selling near $98 for a solid profit, which proved wise as the stock later collapsed below $2. This underscores the crucial importance of taking profits and not falling in love with a stock. It also shows the discipline of buying back another winner, pick and save, at higher prices, $18, $19, after having sold it earlier for a large gain, demonstrating the willingness to correct mistakes, selling too soon, and repurchase a stock when it sets up again and meets the criteria. Don't let ego stop you from getting back in.
Buying back higher. That takes discipline. Any examples of individuals achieving great results more recently?
Yes, another inspiring case mentioned is Lee Freestone. As a young man, just 24 years old at the time, he used the CANSLIM methodology to compete in the prestigious U.S. Investing Championship. He achieved an absolutely incredible 279% return in 1991, earning second place, and followed that up with a 120% return in 1992, again placing second. And critically, these were achieved with real money transactions in a monitored competition, not just hypothetical paper trades. It really showcases the system's power in competitive, real-world conditions, even for younger investors.
Wow, almost 300% in a year. That's incredible. What about testimonials from more everyday investors?
Definitely. The book includes several from regular people. There's Carol T., an anesthesiologist from Massachusetts who transitioned to full-time stock trading. She says she rereads How to Make Money in Stocks many, many times, always finding something new and useful. She considers the book, along with an IBD subscription and online tools, essential for her success. Then there's John B., a real estate broker from Illinois. He reported quadrupling his investment accounts starting in May 2003, and maybe even more impressively, managed to remain essentially flat break even during the severe 2008 bear market by strictly following O'Neill's sell rules. He specifically noted that he only lost money when he deviated from the rules and tried to add his own wrinkles or opinions. That's a powerful lesson right there. These stories, and others like them in the book, really underscore that success in the market isn't primarily about luck or having some innate genius talent. It boils down to hard work,
dedicated study, learning a proven system, and most importantly, having the discipline to execute that system consistently and correct mistakes along the way.
Wow, what an absolutely incredible journey through the world of stock market investing, grounded in O'Neill's work. We've seen how a century of market history reveals these surprisingly consistent, repeating patterns. We've unpacked how the CANSLIM system offers a detailed, step-by-step roadmap for identifying potential market leaders before they make huge moves. And we've learned why understanding the overall market direction, not just focusing on individual stocks, is absolutely paramount for survival and success. We also tackled crucial money management strategies, concentration over diversification, strict loss cutting, and learned from the successes and, perhaps more importantly, the all too common mistakes of real investors.
Yeah, what becomes truly clear after digging into all this is that success in the market really isn't about being lucky or needing to be right all the time. It's much more about thorough preparation, adopting a disciplined, rules-based approach, and having a genuine willingness to continually learn and maybe more importantly, unlearn bad habits. As you've heard from those success stories, it seems anyone with the dedication can achieve significant results, but it definitely requires effort. It's not a get-rich-quick scheme. You absolutely need to identify your past mistakes. Why did you lose money before? And then consciously correct them with sound, historically proven rules that prioritize protecting your capital first and foremost, and then riding your winners effectively.
So, to wrap things up, here's something provocative to ponder as you reflect on this deep dive today. If the market's fundamental laws of supply and demand, driven by underlying human nature and crowd psychology, remain remarkably constant across decades, across different technologies and economic eras, what deeply ingrained human behavior, what emotional bias or old assumption are you still holding on to right now that might be silently holding your own investments back? This deep dive strongly suggests that the biggest obstacle to investment success often isn't the complexity of the market itself, but perhaps, more often than not, it's ourselves.